All right, let's jump straight into it. Welcome to this explainer. For more than half a century, the story of Berkshire Hathaway was basically synonymous with just one man, right? Warren Buffett. As the Oracle of Omaha, he built an absolute legend of an empire. But history just turned a massive page, and today we're looking at the Q2 2026 earnings report, which represents a truly monumental shift. The baton has officially been passed. The historic transition from Warren Buffett to Greg Abel is no longer just theoretical. It is here, it is happening, and the numbers are finally in.
So let's tackle the multi-billion-dollar question head-on. When Greg Abel officially took the reins as CEO back in January 2026, he inherited an absolute fortress of capital. And literally everyone in the financial world was asking the exact same thing. What on earth is he going to do with all that money? Is he going to just sit on it like Buffett did in his later years, waiting for that one perfect pitch? Or is he going to step up and start swinging? Well, the Q2 2026 report just gave us our answer. And honestly, it is fascinating.
Here's how we're going to break it all down today. 1. The Abel era begins. 2. Unpacking the big numbers. 3. The massive spending spree. 4. Wall Street's reaction. And finally, 5. Reading the fine print.
Starting with Section 1, the Abel era begins.
It's kind of wild how fast this transition actually materialized when you look at the timeline. We all remember May 2025, when Buffett officially announced he was stepping down. Fast forward to January 2026, and Greg Abel officially takes over the day-to-day operations. But the absolutely crucial date for us today is August 8th, 2026. That's when the Q2 earnings dropped. Because this was Abel's second quarter in charge, it gave us the very first definitive, sustained look at his solo strategy. The training wheels are officially off.
Let's move to Section 2, unpacking the big numbers. Just think about the sheer scale of this revenue jump. Berkshire Hathaway reported total revenue of $101.8 billion. They literally shattered the $100 billion ceiling, easily beating analyst expectations of $96.5 billion and locking in a solid 10% year-over-year increase. And right alongside that, we've got operating earnings coming in at $12.98 billion. That's a 16% jump from a year earlier, comfortably crushing the Zacks consensus estimate.
Now, before we get too carried away, we got to pause and clear up some crucial financial jargon. Both Buffett and Abel are constantly insisting that investors understand this distinction. Operating earnings represent the actual cold, hard profit generated from Berkshire's core businesses. The trains, the energy, the insurance. Unrealized gains, on the other hand, are just paper value changes in their massive stock holdings. Accounting rules require Berkshire to include these unrealized gains in their net income, which, as you can imagine, causes some incredibly wild swings from quarter to quarter.
So keeping that definition in your back pocket, take a look at this massive number, $25.67 billion. That is Berkshire's net earnings attributable to shareholders for the quarter. It literally more than doubled year over year. But remember what we just talked about. A huge chunk of this, $10.9 billion to be exact, came entirely from unrealized paper gains on their equity portfolio. You definitely shouldn't get totally caught up in paper gains, but the undeniable takeaway here is that Berkshire's investment portfolio is performing exceptionally well.
Which brings us to Section 3, the massive spending spree.
To really grasp the magnitude of the spending, you have to understand the starting point. By the end of the first quarter of 2026, Berkshire's was sitting on an unprecedented, record-breaking mountain of cash, $397.4 billion. For years, investors were getting pretty impatient, heavily criticizing the company, wondering why Buffett wasn't deploying it. While Greg Abel clearly heard the critics, and he wasted absolutely no time putting that money to work.
So how did he do it? Abel basically backed up the truck and poured capital into 3 big buckets. First up, buybacks. He dramatically ramped up share repurchases, dropping $4.5 billion in Q2 and another $3.3 billion in July alone. That's $7.8 billion total. Second, equities. They threw serious cash at the stock market, most notably grabbing a massive $10 billion stake in Alphabet. And third, acquisitions. Abel executed a $6.8 billion cash buyout of homebuilder Taylor Morrison, merging it straight into Clayton Properties Group to create the 4th largest homebuilder in the entire U.S.
And here is where we see a massive paradigm shift. For the very first time in 14 consecutive quarters, Berkshire was a net buyer of equities. They bought $23.5 billion in stocks and sold just $3.7 billion. Oh, and about that $10 billion Alphabet stake we just mentioned? According to CNBC, Warren Buffett himself actually initiated that position. That is such a vital detail, right? Because it signals a collaborative, really smooth transition between the two leaders, rather than some abrupt, disjointed changing of the guard.
All of this aggressive deployment led directly to this number, $364.7 billion. That's Berkshire's ending cash balance for the second quarter. Now, obviously, $365 billion is still a totally unfathomable pile of money. But this marks the very first time Berkshire's cash actually declined sequentially in 4 years. The mountain finally shrank.
Moving on to Section 4, Wall Street's reaction.
Spoiler alert, the market absolutely loved what it saw. On August 10th, Berkshire Class A shares surged 3.3% to hit a mind-boggling all-time high of $806,102.81. Class B shares also jumped 3.1% to nearly $538. Both classes of shares hit their absolute highest levels since Buffett announced his departure back in May 2025.
Wall Street analysts were extremely vocal about this, and the aggressively bullish perspective really stands out. UBS analyst Brian Meredith praised the meaningful cash deployment and actually raised his price target for Class A shares to over $906,000 with a buy rating. The stock has gained about 3% this year, and sure, while it's still lagging behind the S&P 500's 13% jump, the confidence from these major institutional players is definitely surging.
But hey, to be completely impartial here, we have to juxtapose that bullish hype with a more cautious reality check. Meyer Shields over at KBW is maintaining an underperform rating. He acknowledges the quarter was solid for sure, but he points out lingering macroeconomic uncertainty and some very real pricing pressures in the property and casualty insurance market. It's a great reminder that even a fortress as big as Berkshire isn't entirely immune to the broader economic weather.
Sitting right in the middle, we have the neutral market consensus, which is summarized perfectly by Kathy Seifert at CFRA Research. She notes that we are slowly, gradually, and subtly seeing Greg assert himself as the new leader. The market clearly recognizes that a genuine strategic pivot is underway, one that absolutely respects the past but is decidedly looking toward a much more active future.
All right, wrapping things up with Section 5, reading the fine print.
Here's where things get a little tricky, because currency fluctuations can seriously distort reality. See, Berkshire carries significant foreign-denominated debt in euros, pounds, and yen. When the US dollar strengthens, the value of that foreign debt drops, and Berkshire gets to record a gain on paper. In Q2 of 2025, they took an $877 million loss from this. But this year, it swung to a $326 million gain. That is a massive $1.2 billion favorable swing entirely on paper, just from currency effects. And this right here is exactly why you must always read the fine print. According to an incredible analysis from The Motley Fool, if you strip away that favorable currency effect we just talked about, that super impressive headline 16% operating earnings growth drops significantly. The actual underlying operating growth of the company is closer to about 5%. Now, it's still growth, absolutely, but it paints a much more grounded, realistic picture of the quarter.
Looking under the hood at the internal operations, it was a bit of a mixed bag. Insurance underwriting was definitely a weak spot, dropping 13%, as Geico really struggled with rising accident claims and heavy ad spending. But on the bright side, look at the rest of the board. Manufacturing, service, and retailing surged 24%. Berkshire Hathaway Energy climbed a massive 27%, and the BNSF Railroad added a solid 6%. So, despite the insurance dip, the underlying businesses are, for the most part, humming along very nicely.
Okay, let's bring this all together. What is the core takeaway you need to know? Greg Abel's second quarter as CEO marks a clear, undeniable shift in capital allocation. After years of patient cash hoarding under Buffett, Abel is now deploying capital aggressively into buybacks, stocks, and huge acquisitions. The message is just unmistakable. Berkshire Hathaway is no longer just a fortress of cash. It is actively open for business.
Which really leaves us with this final, massive question. If a giant like Berkshire is finally moving its unbelievable capital off the sidelines, will this aggressive new spending strategy trigger a broader market shift? And with over $364 billion still left in the war chest, what massive target is Greg Abel going to buy next? Thank you so much for joining me for this explainer. If you want to keep breaking down the complexities of the market, make sure you subscribe for more deep dives. Keep learning, and I'll see you next time.